market. Adam,
That's right, Sri. Well, as we've seen, of course, all these commodity prices come off in the recent weeks. The same thing has happened pretty much for palm oil prices, but they have risen tremendously in the last 2 years. If you take a look at a 12-month chart, palm oil prices have more than doubled to a high of 4,200 ringgit per ton and have since dropped about 900 ringgit per ton to about 3,335. What's fueled this gain in palm oil prices? Well, if you take a look at the chart, the palm oil prices versus soy oil and crude oil, both of these prices, of course, tracking the gains that we've seen in NYMEX light sweet crude prices in the last 2 years. And in fact, we saw an more aggressive appreciation as of December last year as they rose to record highs, but they've since come off, quite substantially. But we could see the dynamics in the spot market change altogether because Bursa Malaysia has just announced a few weeks back that it's going to actually launch palm oil futures in US denominated contracts. As of now, it's actually traded in ringgit. And this is interesting because it's the faltering dollar that's really stoked the prices in commodity prices across the board in many of these markets. And in fact, many oil-producing nations were talking about actually pricing oil in perhaps euros because we've seen such a sharp depreciation in the US dollar. So why is Malaysia going down this route? Well, according to Bursa Malaysia, they're saying that they want to increase liquidity within this contract and sort of widen the investment base to include hedge funds. So if you take a look at palm oil prices, we could certainly see a lot more volatility in the coming months and years, perhaps as we look at a lot of hedge funds that could get into these contracts, and potentially a lot of commodity traders actually only like to buy US dollar commodity denominated funds. Pardon me, Martin. Back to you.
All right, Adam, and also should we stay right here? Let's bring in Kevin Kerr right now. He is editor and analyst at Resource Trader Alert. Joins us right here on set. Kev, good to see you, and good morning. I mean, I guess the simple story right now is the spec money. Adam was talking about that. The hedgies. If they had exposure to credit, they're getting out of their combo positions to deleverage. Some of that money is going into dollar, but this is only a short-term sort of phenomenon.
Well, yeah, first of all, we believe that the dollar has further weakness, and this kind of rally, again, this is on the back of, a 75-point basis cut by the Fed, where the markets were expecting a full point. This is not enough to be considered a rally, first of all. And certainly a lot of this spec money has come into the commodities. Certainly in the gold and oil, we've seen it reach levels that were not based on fundamentals, strictly on a weaker dollar. Okay. So when that spec money's come out, it's probably going to come back in just as quickly.
When, though?
Well, I don't think we're at the bottom for the dollar. I don't think we're done with the little bit of a rally we're going to have here. So when that shakes itself out, probably very shortly, we will see that money come back.
Within this week, you think? We could see dollar weakness
probably
continue?
Next week or next couple weeks, yeah.
Okay.
Well, so given, we're looking at Malaysia potentially pricing crude palm oil futures in US dollars. Do you think, in your opinion, this could lead to a lot more volatility in the crude palm oil prices? Because they're saying a lot of commodity traders or commodity funds tend to only buy US dollar denominated commodities. Could this happen with palm oil now?
Absolutely, absolutely. And there's a lot of interest in the palm oil market. I was in Miami speaking to a lot of hedge fund managers there. I'll be here in Singapore speaking with people this week at the Plantation Asia Conference. A lot of interest in this market. Certainly if it's denominated in dollars, it's going to draw on a lot more fund interest. But agriculture and then the whole sector has grown in the last 3 years. We've seen in the U.S. The volatility we've seen in the markets has been extreme. We've never experienced this in the last couple, 3 years. Certainly in corn-based ethanol has been a big driver of that as well.
That's not going to solve the inflation problem that countries are facing, obviously, because commodity prices have driven up inflationary pressures throughout the globe. So this is obviously a negative for inflation, potentially for maybe Malaysia and the globe, because palm oil is just used in so many products.
Well, certainly, and the commodities that are both food and now fuel, whether it's sugar, corn, palm oil, these are always very sensitive, and it's not good overall for the inflation factor for consumers. Palm oil is another commodity that we'll see that, I think.
Kevin, we've got OPEC saying that oil is going to trade between $80 and $110 this year. Would you say that $80 or thereabouts is fair value for crude oil, given the fact that so many people in the market have been saying that it's inflated above $100 a barrel, doesn't reflect the fundamentals?
At $109, I said we were overpriced. $111, we saw the pullback come in. There was really nothing. There's plenty of crude on the market right now. We usually see a slowdown in Q2 for oil demand, but the demand is there. So, and OPEC has said they'll defend the $80, $85 a barrel level. That probably is the baseline nowadays. I think we have to admit it's not going back to 60 or 65 anytime soon, if ever. And 110, it's quite a range, 80 to 110. I think we'll see the higher end of that range for the rest of the year, not the lower end.
Kev, real quickly, I mean, your guess is probably as good as mine, but at just under $100, 50 cents a barrel, how much of the spec bid is still in this price, do you think?
Probably another $10. You know, there typically we would say they're about $12 to $13 of spec money. I'd say it's been up to about 20. When we were at 111 a barrel, there's probably about $20 of spec in that. It's very subjective, but the physical demand is really there, and the numbers we heard earlier coming out of Beijing, the physical demand will come in, I think, higher than people expect, probably at $90.
Good to know. Kev, got to go. Great to talk to you, sir.
Thank you.
We are speaking with Kevin Kerr, editor and analyst at Resource Trader Alert. Also, my good colleagues Sri Jagaraja and also Adam Bakhtar. We'll have to leave it there for this Monday edition of Squawk Box. Keep it right here, though, because CNBC's Cash Flow is up next. Don't go away.